Let's open it up for questions.
So explain to me the difference between a whole life policy and an indexed annuity policy. What are the main differences?
There's an amazing white paper. Ernst & Young, one of the largest accounting firms, released showing how an investment-only portfolio will underperform a portfolio that has cash value life insurance, whole life, and an annuity built into it. But in the Ernst & Young assumption, they don't incorporate the annuity into the portfolio until about age 50, 55, somewhere in that range. If you're under the age of 50, 55, most likely the annuity is not for you. Think of the annuity as a bond replacement. So for example, I'm 44. I do not own an annuity. My agency sells millions of dollars worth of this annuity every year. But I'm putting all my money into cash value life insurance right now. I have a lot of term, about $6 million of term that I'm currently trying to convert as much as possible. The advantage of cash value life insurance is that it accumulates technically income tax deferred, but we can access it income tax free. Later on, you actually have the leveraged death benefit. So with annuities, by the way, there's a 10% penalty for any withdrawals before the age of 59 and a half. So think of the annuity really as that bond replacement and for retirement income. In the best simplified way of saying it, does that make sense?
Yeah, that makes sense. Why not just keep the cash value whole life policy? Why buy an annuity if they already have that? Or is this assuming they don't have that?
We would never say to replace your whole life with the annuity. This would be a portion of the portfolio. A lot of people think of an investment portfolio as, say, 80-20 stocks and bonds or 60-40 stocks and bonds. So what Ernst & Young does, without bringing up the report, they assume early on that you have just cash value life insurance and investments. And then at about that age 50 or so, you take up 30% of that portfolio in investments and you move that into the annuity. Because once again, the annuity is built for retirement income. An investment portfolio is not built for retirement income. And whole life has a feature to it. I'm not going to get into this, but there's a great book, Dr. Wade Pfau. There's a whole chapter in here about whole life. This book is one of the only books that I actually hand out to clients. And whole life can work as a volatility buffer in retirement. And Dr. Wade Pfau, by the way, is considered one of the foremost experts in retirement income. He shows in the book that when you're pulling money out in retirement and we have a market downturn, one of the worst things you can do to a portfolio is continue to take money out of that portfolio after you just got whacked in the market. So what you would do instead is take money out of your whole life policy to provide the income to give your investment portion of the portfolio to actually grow back. So during the good years, you pull money out of the annuity and your investment part. During the bad years, you use your whole life policy as a volatility buffer. And Dr. Pfau has shown that if you have a volatility buffer, your portfolio may last 10 years or longer just by doing that strategy. So it's very powerful.
Okay. Yeah, that's very helpful. So this particular annuity, I see the interest credited. I heard that you use buffer strategy with options within the product, but how does the company decide what return you get when the market's positive?
It's linked to an index. This is based on the Barclays US Tech 12% volatility index. We could even send you a link if you wanted to check it out right on Barclays website. Of course, Barclays is one of the largest financial institutions out there. There's a 1 and 2 year strategy, but let's just use the 1 year for an example. It has a participation rate of 70%. Let's pretend the index for that year makes 10%. You would get credited 7%. Now, why do we use that index? It's one of the options we have, but because it's linked to the NASDAQ 100, it's the most volatile index I can get my hands on in this annuity. And I want the most volatile. Now, why would I want the most volatile? Remember, the floor is zero. You can never lose any money, even if the NASDAQ goes down by 30%. And if you have 100% of your money in that index, yes, you might make nothing for that year, but you're not going to take any of the losses. But on the years that it's up, you're going to get 70% of those gains. This is the power of the annuity. And this is where a bond can't do that, because with a bond, we always have two major risks. We have market risk and interest rate risk. You probably remember a couple of years ago, 2022, where bonds performed worse than stocks. It was the worst bond market supposedly in the history of the United States.
Yeah.
Now, I do use some bonds, but that's for clients, but I'm using some very specialized bonds. But for the most part, we recommend replacing the bond portion of the portfolio with both whole life and with this, the Aquila X, this fixed indexed annuity, because then you eliminate that market risk and that interest rate risk.
Okay.
And by the way, these returns credit are back tested for the last 20 years. Let's take the S&P 500, even though it's not based on the S&P, it's a NASDAQ 100. The NASDAQ's similar. The S&P historically is up 63% of the time. It's down 37% of the time.
Yep.
So if we include any return here, it's interesting. Any return 1% or less. If you do the math on here, this is assuming roughly 60% of the time you're going to make more than 1%, but you're not going to make anything 40% of the time. I've seen companies that manipulate the back-tested returns. GCU does not do that. So the power of this is we want to stay in it. Yeah, we're going to get some zeros. Your money's going to sit there and make a zero 40% of the time. But you're going to be sitting there because your money did not lose any money. You're also going to get some very nice returns. And if you notice, I'm assuming a 7% based off $1 million. I'm taking out $70,000 a year. And that's powerful. We go even further. At age 95, the portfolio goes under what you started with at 500,000. By that point, at age 95, you've taken out $2.1 million. You still have 521,000, and you were not subjected to any market risk. So when people say, oh, annuities are no good, I'm like, really? Show me any investment portfolio that you can do this, because you really can't tell me how the market's going to react. And I know this is based off of assumptions as well, but I protect my floor of zero. So I eliminate the sequence of returns, which is really a big deal.
Yeah, I think it's interesting that it's indexed to, for all intensive purposes, the tech sector. If you were to do that for the last 50 years, I'm not sure you would get the same returns. And tech wasn't really a big deal until the middle to late 90s, which is why I'm assuming this is hypothetical, because you just don't have the time that the S&P has been around. But yeah, by taking on the extra risk in the NASDAQ, you can get a return like this. So that's very interesting. I think people get a bad rap with annuities because they think there's a ceiling and a floor, whereas the ceiling here is really spelled out. You're going to get 70% of what the return is in any given year. But yeah, I've never heard of anything like this. It's very interesting.
I don't share my analytical side with my clients, but I've been in this business now over 23 years, and I really enjoy tearing apart annuities. 90% of our annuity business is this product. I know this company. I know the executives of this company. I've compared this product against all the other out there. And I've gone on record. I even have a testimonial. I've said I truly believe this is the finest fixed indexed annuity in America. Another cool thing is that you can see that there's a surrender charge for the first 10 years. That's the way the insurance company protects themselves. But most FIAs have a surrender charge plus a market value adjustment, which means that if you go to try to surrender this, and by the way, I've only ever had one of these surrendered, and that lady, God bless her, it was one of my agents, because I have agents spread all across the country. I don't think she understood what she had, and she decided to put it back into a CD. And there's no CD that's ever going to outperform this. Going back to the market value adjustment, that's like a surrender charge on top of a surrender charge. So if you go to surrender this, In a rising interest rate environment, and a lot of these other companies, FIAs, you're actually going to have a very big surrender charge. With this assumption, you could technically walk away after year 2 with your money. Most companies don't allow you to do that. GC wouldn't want to see you do that. But a lot of people think that, oh, once you buy an annuity, you're stuck in the product. I have my own family in this, friends. Once again, I would not recommend this product as much as I do if I didn't truly believe in it. I know the executives of this company. A lot of companies, there's new money and old money. If you deposit money into this, your money is only considered new money for 1 year. After 1 year, your money is considered old money. And a lot of these secular for-profit companies will reduce your participation rate in the indexes. It's a nasty little thing insurance companies do. GCU does not do that. They have linked rates, which means the new money and old money rates are exactly the same. So if you have this 5 years later, you're going to get the same participation in the index as the new money. There's no fee on this. This product has both a fee option and a no fee option. And I'm not going to get into, there's reasons why we'd want to charge the fee, but I showed you the no fee option, which is built purely for accumulation. So you will never be charged a single dime for a fee in this product. There's no fee drag whatsoever. That's very powerful as well.
Are you just getting a percent less as a part of your return, or how does that work?
What do you mean? Because of the no fee?
Right.
No, that's the way they have this built. Our compensation, this is a commission-based product that does not come out of your values. Let me contrast. Why would you want to do the fee? If we charge you a 95 basis point fee, they would actually give you a 10% bonus on your money. So instead, immediately, you would get a $50,000 bonus added to the account. So you'd start with 550 instead of 500. And you would actually get, see this available lifetime income that I mentioned, the wellness benefit rider, it would be double. So for a client that is really worried about long-term care down the road, we would want to charge the fee. About 75% of our clients end up taking the fee-based one versus the no fee. But for younger clients, this guy's 55. Typically, the no fee is the way to go. Another reason we would charge the fee is to get that bonus is if we have somebody that's in another annuity and they have a surrender charge, we use the bonus to offset the surrender charge they would have at the other annuity company. There's times to charge the fee. There's times not to charge the fee. In this example, it just made sense to not charge the fee.
Okay. Thanks for explaining everything.
It's an amazing bond replacement, whether it be 20%, 30%. I have some clients, they have the majority of their money in this product. And by the way, this also comes with a fixed account too. I'm just showing the index. The fixed account is currently paying 4.75%, very similar to what a 10-year treasury is paying right now. So most of our clients actually have a portion of their money in the fixed account, whether it be 10 or 20%, because even if the index doesn't hit for that year, their account value is always going up.
Yeah, then my last question is, how do you get into this product? Is it technically a life insurance product, or is it just an annuity,
No,
or how do you qualify for it?
first of all, the good part is everybody qualifies. There's no underwriting. That's one advantage to the annuity. It's a $10,000 minimum deposit. It is an annuity. It's not life insurance, so it doesn't have a leveraged death benefit. Annuities are built for long-term savings, not short-term, and primarily within the future to pull out money for retirement income. $10,000 minimum. You have 1 year from the date of opening the account to put additional money into there. Typically, you can put up to $1 million into it. Occasionally, I have people that want to put more than $1 million into it, and I get a special exception to do that. Now, if say it's after a year and now you have additional, you say, I really like this, but I've had it for over a year, then you would just take out another contract. So I have clients that have 3, 4 of these. I'm just showing here a non-qualified annuity, by the way, which means it's just cash being thrown into it. But we can also do these. We do 401k rollovers all the time.
Yeah, that was my next question is usually your biggest asset was your house. Now your biggest asset's probably your 401k. So you don't want to take the money out and have a huge tax burden. So you can roll this over. That was my next question.
No taxable event, it would be rolled into, if it's a traditional 401k, it would get rolled into a traditional IRA. If it's a Roth 401k, it gets rolled into a Roth version. If someone has a traditional IRA, it can just be transferred right into it. So the annuity, the wrapper, what I call, so we can put different wrappers on this. We can traditional IRA, Roth IRA, non-qualified. We do a lot of CD replacements. People have a CD that's coming due and they're not happy with what it's paying. So yeah, taxable event. No, there's never any issues with that, of course.
Yeah, it's a great question, Tony. And this is a great product, but my somewhat controversial take, because I have a different sort of paradigm. So for me personally, anything that touches what we euphemistically call the market, meaning the Wall Street casino, I generally don't want to play around with it unless I'm going to buy a highly speculative individual stock as an investment. Now, this is just me. I'm not talking about the average person. So for me, with infinite banking, I'm trying to plow all of my capital, or as much as I can, through my whole life insurance policy and use that as my primary financing and capital accumulation tool for everything that I'm going to do subsequently. So for me, I don't know that I would have a use for an annuity, but I'm not the average person. The average person does believe in the Wall Street investment paradigm. So they have money in retirement accounts. They buy the S&P 500 index, mutual funds, things like that. So they start accumulating money where it's at risk in the market. If you're already in that paradigm, then I think this can make a lot of sense as an alternative to say, hey, Mr. Jones, you built up a large account value in the market. And when you start getting towards retirement, their paradigm starts to shift because they realize the size of my nest egg is not as important as how much income can I safely get out of it. I've built up this nest egg. How long is it going to last me? When they start asking those questions, that's where an annuity makes a lot more sense, because an annuity is primarily an income generation tool. So you may have heard the phrase, we're going to annuitize the portfolio. That's what you do as you approach retirement, is trade this lump sum of at-risk capital for a steady, reliable, guaranteed income stream that is never going to run out. It's just like a pension. I'm setting up my own pension. And annuities are tools for doing that. The simplest way would be a SPIA, a single premium immediate annuity, which means I'm going to take my $1 million and I'm going to buy $1 million SPIA. And now my $1 million goes away, but I get a guaranteed income stream instead. Why would you do that? Well, there's something called the 4% rule, which you may be familiar with, which says that if you have built up assets in the market, you cannot safely withdraw more than 4% per year without risking running out of money before you die. So if you have this $1 million, you can only take $40,000 a year in income safely. But depending on my age, if I move it into a SPIA, they can probably guarantee me $60,000 a year in income. And that'll never run out, or maybe 80,000, depending on my age. A fixed index annuity, you can turn on the income at any point in time, but you can continue to accumulate in the interim. The advantage is obviously you get protection good, and you can draw more income safely out of it than you could if you just left it in the market. The drawback, obviously, is you lose some liquidity. You give up some of that liquidity, and then you don't have full access to the upside of the market. Those are the trade-offs as I see them. If someone is a true believer in infinite banking and they're really, truly building up that capital, I think the use case for an annuity becomes less.
Yeah. I'll give you a good example of one we recently did down in Houston, Texas. The guy was retiring, 65 years old. he has a pension because it's an oil refinery. And he was trying to decide if he was going to take a joint life or a straight life on that pension option. We got him approved for a cash value life insurance policy. So he took a portion of the money, went into an investment portfolio that I'm managing. 300,000 went into this. We're going to pull money out of this on an annual basis to actually fund that life insurance policy. So what are we doing? We're paying the taxes every year because it's a traditional IRA annuity. We're stripping out the taxes, about a 15% effective tax rate, and then he's going to use that to fund his life insurance, which was backing up the fact that he's taking a life-only option. So if something, heaven forbid, were to happen to him, his wife is protected. So that's, as Logan was saying, when he built up, I forget the exact number, let's just say roughly $1 million in 401k money. So now in the long run, he's going to have about 300 some thousand in his cash value life insurance policy after about 10 years. He's going to have his annuity here. And then I'm also managing the other portion of the portfolio.
Yep. I love that, Peter, because it shows how we're tempted to look at these products in isolation. Like it's this one thing or it's this other thing. It's just this one thing. No, when you use these products in conjunction with each other and part of an overall strategy, like using an annuity to fund a whole life insurance policy.
Absolutely.
That's where things can get really powerful. You maximize the positives of each tool while minimizing the negatives by complementing it with a different product.
I've coined this term. I believe it's financial malpractice now I'm a quote unquote fiduciary, but I think it's financial malpractice for some fiduciary or financial advisor, whatever you want to call them, to say, yeah, we're just going to put all your money into the market and that's what we're going to do. I'm sorry. I got Ernst & Young with their white paper to back it up. If your plan is to maximize retirement income and legacy, it's based on mathematical, scientific, and economic facts that a portfolio that has cash value life insurance, an annuity, and some investments in the long run will outperform that investment only portfolio. And I think it is so egregious that all Wall Street wants to talk about is just put all your money in the market. It's not going to perform as well. And Ernst & Young, who doesn't sell any life insurance annuities or any investments, are one of the largest accounting firms. They've ran the numbers and they've gotten attacked by Wall Street for producing that white paper. And I share it with clients all the time because it's powerful stuff.
So essentially, the three ways you're using for that one client, the whole life policy becomes their cash position. And I'm assuming the premiums are pretty hefty because of his age.
It's a 13 pay. The way I designed it, it's $35,000 a year for 13 years.
And that's okay because he's using it as a retirement / savings account / legacy account / life insurance policy. So it becomes very dynamic. Okay, I follow you.
Yeah. And by the way, he already wanted to do Roth conversions. So when he said that to me, I said, do you realize we can do something similar with a life insurance policy? And he already had an issue that he wanted to take the life only pension. So he was like, oh, this is wonderful. I can do multiple things with this life insurance policy. I said, exactly. And I almost didn't get him approved. He had some health issues. We actually ended up placing that case with the Catholic Order of Foresters. I'm one of their general agents and 2 other companies. We applied with multiple companies. 2 of the largest companies in this country declined him. The Catholic Order of Foresters gave me what we call a rated policy, but it still worked beautifully. And I was able to get it done. That's another thing why I love fraternal insurance companies. They will often take some risk that other companies aren't willing to take, especially when it's one of their top agencies and I'm going to bat for that client. That's another thing I've tried to build my reputation on, is whether it be my own client or one of my agents like Logan, while that's going through underwriting, I'm doing everything possible to get that case through. So, yeah.
Yeah. And then on your other product, how do you value the child's life? What number gets put on that when they're just born?
I'm actually going to defer to Logan because I think Logan does a finer job of this than anyone else of my agent. I'm not saying that just because I'm doing this call with him. So Logan, I'm going to let you talk about that.
The short answer is With the Catholic Order of Foresters, your children are eligible for half of the amount of death benefit that you have on the parent, on the highest insured parent. So if your insurability is $3 million, so let's say you're 25 years old, you make $100,000 a year, your insurability, your human life value is $3 million. So any of your children are now eligible for up to $1.5 million. Convertible term on a child is extremely powerful because you're locking in their insurability at a very young age and you're giving them maximum optionality. And there's flexibility in this term policy that is amazing, where you can extend the term. You can pretty much do anything except increase the death benefit. Obviously, you can convert it to a very good competitive whole life insurance product. There are insurance companies out there that will let you have the same amount of death benefit on a child as on the parent, even up to 25% more if you can justify it. But those insurance carriers will only do whole life insurance on juveniles. They will not do term. So if you had a significant chunk of change to put into a juvenile policy, you could do that. And by the way, it is harder to get significant amounts of money into a whole life insurance policy on the child because the death benefit is so inexpensive. It's harder to pay a super high premium into a policy on a juvenile when you're talking about a whole life insurance.
So this is term, and it's term until you try to convert it?
Correct. It is 100% convertible.
And let me just mention, these rates are locked in. You can see right here, 60 years I built this for. So when we build these for you, I just picked 60 years. We could pick 50 years. We could pick 40 years. This is why I call this the most flexible term product on the market, because you get to pick. I could run this for 70 years. The premium would just go up. And when you go to convert it, I just want to mention, you don't have to convert all $1 million at once. Let's just say 3 years down the road, you have this for your child. Often what happens is a parent will convert 100,000 at a time. So at that point, you would have a $100,000 whole life policy. You would now have $900,000 of term. And then a couple of years later, you convert another chunk if you want to, and on.
Go down to the ledger, Peter. I don't know if you covered this, but there's incredible amount of flexibility in this policy. It grows accumulated value. Most term policies, there's no accumulated value. Now, accumulated value is not the same as cash value. This is not a whole life insurance policy. Let's be clear on that. So you have zero cash value. Let's be clear on that. But if you were to convert the entire $1 million of death benefit, which would not be that expensive on a juvenile, that accumulated value would go into the new whole life policy as cash value. Let's say in year 5, you converted this $1 million. $4,500 of cash value would go into your whole life policy. So through those 5 years, you paid $5,132 in premiums. But when you do the conversion, you're starting with $4,500 of cash value. So on net, you really only paid a little over $500 for that 5 years of term coverage on your child. Not only does the accumulated value go over to that new policy, you can also use the accumulated value to pay premiums. Now, if you did that, the term would shorten up. There would be some consequences. The death benefit would stay the same, but the length of the term would go down. But it's good to know that you have those options. And then, of course, midway through, you could actually extend the term longer if you wanted to. The premium would go up. But let's say 5 years in, you wanted to extend the term. You could do that. With this length of term, you probably wouldn't need to. But if you had taken out a 10-year term on your child, maybe 5 years in, you decide you want to extend it and make it a 20-year term, you can do that. The premium would go up, but that's flexibility you're not going to find in any other term product. Every other term product I'm aware of, once you have the term is locked in, there's certainly no accumulated value.
Yeah, so that's interesting. So the accumulated value turns into the cash value. Is that one for one, or is that they take a cut?
Yes, one for one if you do a full conversion. So when you convert the whole million, it doesn't go over for partial conversions. I won't get into the technical details of why that's the case, but this is something that is unique to the captive order of foresters.
If you did 100,000, Peter, like you mentioned, then until you got to the million, it would flow, or no, you would lose it if you did partial every time.
You wouldn't lose the accumulated value. It would just stay in the term policy. It wouldn't go over to the whole life policy, though.
Right.
Unless you go full.
Until you convert the full thing.
Or until you convert the full thing. So you can still slice and dice it, but you have to wait
Yes.
until you convert the whole thing. And then
Correct.
let's say you do a 30-year term and then you convert it. Let's say they're 8 years old now and you convert it when they're 22 so that they can start to pull from the cash value in the whole life. They would have to go through underwriting, I'm assuming, for conversion.
No. This is a conversion. That's the beauty of it. It would be a conversion, not a new policy.